From the time we're young, we hear a simple idea about money. Big risks lead to big rewards. And it sounds believable. Movies celebrate the person who puts everything on the line and somehow walks away rich. Business culture isn't much different. We're constantly told to take the leap, bet on ourselves, quit the safe job, and figure out the details later. It's a great story. It's just not how smart wealth building usually works. Look closely at successful investors and entrepreneurs, and you'll notice something interesting. Many of them aren't trying to take the biggest risk possible. They're trying to find situations where the risk is manageable. But the reward, if things go well, could be enormous. That's a very different game. It's often described as asymmetric upside. The basic idea is surprisingly simple. You want to know what you can lose before you make the bet, while leaving as much room as possible for what you can gain. Imagine putting $1,000 into an opportunity. If the most you can realistically lose is that $1,000, but a successful outcome could eventually return $10,000, $50,000, or even more, the two sides of the equation aren't equal. Your downside has a ceiling. Your upside doesn't necessarily have one. Now compare that with the way many financial decisions are made. People often focus almost entirely on the expected reward. How much can I make? A better question might be, what happens if I'm wrong? Because getting wealthy isn't only about finding opportunities that can make money. It's also about surviving the ones that don't. And once you understand that, risk starts to look very different. The goal isn't to avoid risk completely. It's to stop taking risks where the downside can destroy you, and start looking for opportunities where being wrong costs relatively little, while being right can change the outcome completely. That principle doesn't apply only to investing. It can change the way you think about business, careers, side projects, and even how you use your time. And that's where asymmetric upside becomes much more than an investing term. It becomes a way of making decisions. Here's where this idea becomes practical. Not every decision deserves the same amount of time, but we often behave as if it does. Someone might spend 3 weeks debating the color of a button on a website and then decide to quit a job or change careers after one bad afternoon. The problem isn't necessarily bad judgment. It's failing to recognize that different decisions carry very different consequences. Jeff Bezos had a useful framework for this inside Amazon. He described decisions as either Type 1 or Type 2. Type 1 decisions are one-way doors. You walk through, the door closes behind you, and reversing the decision is either extremely difficult or extremely expensive. Selling a company could be one. Taking on a dangerous amount of debt could be another. Giving away a large piece of your equity may also qualify. These decisions deserve time. You want the numbers. You want different opinions. You want to think about what could go wrong. Because if you're wrong, fixing the mistake may not be easy. But then there are Type 2 decisions. These are two-way doors. You walk through, take a look around, and if you don't like what you find, you walk back. Maybe you test a new product feature and customers don't care. You remove it. Maybe you hire a contractor for a small project and it doesn't work out. You don't renew the contract. Maybe you send a proposal to a client you've always wanted to work with and they say no. Nothing catastrophic happened. You learned something. And this distinction matters because people often spend Type 1 amounts of time worrying about Type 2 decisions. That's expensive. Not necessarily in dollars, but in lost opportunities, delayed experiments, and information you could have gained simply by trying. This is where asymmetric thinking becomes useful. When a decision is reversible and the downside is small, you don't always need certainty before you act. Sometimes the experiment itself gives you the information you were waiting for. So before spending another week trying to make the perfect decision, ask a much simpler question. Is this really a one-way door? If it isn't, you may be better off opening it and finding out what's on the other side. Most of us are taught to think about money by trying to predict what happens next. Where will the market be 6 months from now? Will interest rates fall? Which industry will explode? Which company will become the next giant? And if you listen to enough financial commentary, you can start believing that successful investing is mostly a competition to see who can predict the future better. But there's a problem. The events that matter most are often the ones nobody sees coming. Nassim Taleb has spent much of his work exploring this problem. Rare events, uncertainty, and what happens when reality refuses to follow our forecasts. His answer isn't to become better at predicting every surprise. It's to build a position where you don't have to. This brings us to two closely related ideas: convexity and optionality. They sound complicated, but the intuition is simple. Imagine an opportunity where a bad outcome costs you a small, predefined amount. That's your downside. But if something unexpectedly goes very right, your potential gain can be many times larger. Now, uncertainty isn't necessarily your enemy. In the right setup, uncertainty can actually help you. Think about investing in a group of very early-stage companies. You already know that several may go nowhere. Some may fail completely. But you don't need every investment to succeed. If your losses on each individual bet are limited, while one exceptional company can return many times what you invested, a single outlier can potentially compensate for a long list of disappointments. You didn't have to predict exactly which company would become the winner. You needed exposure to the possibility of one. That's optionality. And it changes the question you're asking. Instead of, "What do I think is going to happen?" you begin asking, "If something unexpected happens, what happens to me? Do I lose everything? Do I survive? Or could I actually benefit?" That's a very different way to think about uncertainty. Because sometimes the smartest position isn't the one that requires you to predict the future correctly. It's the one that allows you to be wrong repeatedly, survive those mistakes, and still participate when something extraordinary finally goes right. There's another place where asymmetric thinking becomes especially powerful: your career. For most people, income begins as a fairly simple exchange. You give someone your time, and they give you money. There's nothing inherently wrong with that. A salary can provide stability, build skills, and give you the capital to invest in other opportunities. But it has one obvious limitation: time doesn't scale. You can become more valuable. You can negotiate a higher salary. You can charge more per hour. But eventually, you run into the same constraint everyone does. There are only so many hours you can work. This is why leverage matters. Entrepreneur and investor Naval Ravikant has often talked about forms of leverage that don't require your time to increase alongside your output. Code is one example. You can spend months building a piece of software, but once it exists, another 1,000 people can use it without requiring another 1,000 months of your time. Media works in a similar way. You record a video once. 10 people might watch it, or 10 million might watch it. The work required to create the original video doesn't increase 10 million times. Capital can also be leveraged. Instead of your labor producing every additional dollar, assets you've accumulated can continue working after the initial decision has been made. Notice what all of these have in common. There's a separation between input and potential output. That's the key. With linear work, producing twice as much usually requires something close to twice the effort. With leverage, that relationship can break. And this doesn't mean everyone should quit their job tomorrow and start a software company. That would miss the point entirely. A job can actually be the thing that funds your asymmetric bets. The more useful question is what you're building alongside your linear income. Are you creating something that can keep producing value after today's work is finished? A piece of software, a business, a library of useful content, intellectual property, investments, a system that can operate without your constant presence. At first, these things may produce almost nothing. That's what makes them easy to ignore. But unlike an hour you've already sold, an asset can continue creating value tomorrow, next year, and potentially for decades. So the goal isn't necessarily to stop trading time for money. It's to gradually use some of that time and money to build things that no longer require the trade. Once you start thinking this way, asymmetry stops being just an investing concept. You begin seeing it everywhere. In your career, in the projects you choose, in the skills you learn, even in the way you decide what deserves your time. And something interesting happens. You stop using effort itself as the measure of progress. Working 12 exhausting hours can feel productive. But if those 12 hours disappear the moment the day ends, while someone else spends 2 hours building something that continues creating value for years, effort alone doesn't tell you very much. What matters is what that effort produces. And ultimately, that's why leverage, optionality, and asymmetric upside matter. Not because they guarantee wealth. They don't. And not because every small bet will eventually become a huge success. Most won't. Their real value is that they can gradually give you something money is supposed to provide in the first place. More control over your life. Control over your time. Control over what you work on. And eventually, if things go well, the ability to make decisions based less on what you have to do and more on what you actually want to do. So look at the decisions sitting in front of you right now. Not the reckless ones. Not the decisions that could wipe out your savings or put your future at risk. Look at the small, reversible ones. The skill you've been thinking about learning. The person you've been meaning to contact. The idea you could test this weekend. The project you could launch before you feel completely ready. Some of them will go nowhere. That's fine. Because when the downside is a few hours, a little money, or the discomfort of hearing no, you don't need every attempt to work. You need to survive the ones that don't, and stay in the game long enough to find the few that do. That's the deeper lesson behind asymmetric upside. You don't need to bet your life on one perfect opportunity. Protect the downside. Keep creating options. And when you find a situation where the potential reward is dramatically larger than what you can afford to lose, take the shot.